If you think this new retirement account is mainly about helping people save for old age, you are seeing only the surface. The surface matters. It is just not the whole story. That is the first thing I want you to understand. On the surface, the Trump IRA sounds simple, even generous. Millions of workers do not have access to a 401k. Fees in many retirement plans are too high. Portability is clumsy. Minimums can discourage the very people who most need to start. So now the government comes in and says, fine, we will build a new door, lower fees, wider access, smaller minimums, a possible government match for lower income workers, a retirement account that follows the worker rather than the employer. That all sounds good. And parts of it are good, but when a policy sounds this helpful, I have learned to ask a second question immediately. Helpful to whom? That is the mother line. The Trump IRA is not only a retirement reform, it is also a system for moving more workers and more government-created money directly into the stock market. That is the deeper story, and once you see that, the whole thing stops looking like a simple personal finance update and starts looking like a structural shift in how America wants to fund retirement, support asset prices, and pull more people into the ownership class without ever fixing the underlying disease of the dollar. That is where the real thinking begins. Let me start where the source document starts, because that is the right place. The old 401k system has three weaknesses that matter. First, yes, if your employer does not offer a 401k, you are simply outside the machine. Second, fees. Many workers do not even understand how much wealth gets siphoned out of their accounts over decades through expense ratios and plan level costs. Third, portability. People change jobs, lose jobs, piece together gig work, freelance, drive, hustle, stack income from different places. And the old employer-tied structure was built for a labor market that does not really exist anymore. That critique is fair. The source text says there are about 56 million workers in the United States who do not have access to a 401k, even if that number moves around in future estimates. The underlying point is right. A very large number of workers are outside the employer. Match retirement machine, that means two Americas have been developing side by side. One America gets payroll automation, tax-advantaged investing, and sometimes free employer money. The other America gets wages, bills, and the instruction to somehow save on its own without the same rails. That is not a small gap. That is a wealth gap. So when the Trump administration says the account should be for everybody who works, not just people employed by firms with the right benefit structure, I understand the appeal immediately. That is the first mechanism I want you to understand. I call it access expansion. The fastest way to change financial behavior in a country is not by giving a better speech. It is by changing the rails. People do not become investors because you shame them into it. They become investors when the system makes ownership frictionless enough that participation becomes normal. That is what the 401k did for one class of workers. It quietly turned investing into a default payroll behavior that is incredibly powerful. A person can be financially mediocre in almost every other way and still build real wealth if enough money keeps getting piped into productive assets for decades. That is the magic of rails, and that is why the Trump IRA matters more than the public first thinks. It is not only another account, it is another rail. Now let us talk about fees, because the source document is right to make them a central villain. Most people hear a fee and think nuisance. They do not think theft. They should think much closer to theft. Not illegal theft, slow theft, quiet theft, institutional theft with a prospectus. If a worker invests $500 a month for 30 years, gets decent market returns, and then loses a six-figure amount to fees over time, that is not a detail. That is a transfer of the worker's future into somebody else's operating income that matters. This is the second mechanism. I call it invisible compounding in reverse. People think compounding only works for them. That is not true. Fees compound too. And the cruel genius of high fees is that they do not look like a robbery scene. They look like a decimal. A 1.26% annual drag does not sound like violence when you first hear it, but drag it through 3 decades of payroll contributions, reinvestment, and foregone compounding. And suddenly the worker retires with dramatically less than the gross market history suggested was possible. That is why low-fee structures deserve respect. The source text contrasts the rough average 401k fee with a proposed Trump IRA cap around 0.15%. Even if future implementation gets messy, the direction of that argument is very important. Lower fees do not just save money, they reduce leakage from the compounding machine that can change a worker's retirement outcome far more than most people appreciate. So yes, on the first layer, the Trump IRA could be genuinely useful. Access broader fees, lower portability, easier, minimum smaller. Those are all real improvements if implemented cleanly, but now we get to the deeper layer, and this is where the document becomes much more interesting than a normal retirement explainer. The government match. The source file makes a big deal of this, and it should. Lower income workers who qualify could potentially receive up to $1,000 a year in matching contributions, phased according to income and personal contribution levels. That sounds like free money. It is intended to sound like free money. Politically, it is brilliant language. Psychologically, it is irresistible language. And financially, it is where the entire system reveals its deeper intention, because free money is never really free. This is the third mechanism. I call it subsidy routing. Whenever the government subsidizes behavior, you should ask where the subsidy is being routed. In this case, the answer is not vague. It is routed into the stock market. The state is not only encouraging savings, it is steering savings into financial assets. It is trying to widen the investor base, deepen participation, and help move more citizens from pure wage dependency into some level of equity ownership that can help households. It can also help the market itself. This is the key insight the average viewer misses. The government is not only helping workers enter the machine, the government is feeding the machine. That is a big difference. Now let us be honest in one sense. That is good. Broad ownership in productive assets is better than broad dependency on decaying cash balances. A country where more workers own pieces of the economy is generally healthier than a country where most workers only hold wages and watch inflation eat them alive. So I do not reject the impulse. In fact, I understand it completely. But I do not like pretending that a government can hand out subsidies into the market without consequences. That is where naive people get hurt. The source text is exactly right to ask the most adult question of all: where does the money come from? That is the fourth mechanism. I call it the funding truth. The United States government does not have some magical hidden vault where free retirement contributions sit waiting to be distributed. If tax revenue is roughly $5 trillion and spending is roughly $7 trillion, then the base condition of the federal government is already deficit. It is already living beyond current revenue. So when the state promises one more support mechanism, one more match, one more contribution stream, one more way to help people save, we should not ask only whether the policy sounds compassionate. We should ask what pays for it. And in a deficit system, the answer is usually debt from the public, debt from foreign holders, debt absorbed directly or indirectly through the monetary machinery of the system. This is the part polite conversations try to skip, because once you say it clearly, the whole emotional tone changes. The government is not giving free money. It is borrowing or monetizing money and then routing it into a politically attractive destination. That destination here is retirement investment, which sounds cleaner than almost any other form of subsidy, but the monetary logic does not disappear just because the target feels virtuous. If more government obligations are funded through more debt in a system already stretched, then the macro cost tends to arrive through the same old channel: weaker dollar, higher long-run inflation pressure, more asset inflation, more divergence between owners and pure earners. That is the real engine. This is the fifth mechanism. I call it inflationary inclusion. The state can widen asset access and still worsen the monetary environment that punishes savers who remain outside assets. That is what makes this policy so clever and so dangerous at the same time. It says to the worker, we will help you get in, but the very act of doing so may also intensify the conditions that make being outside assets even worse. The government is not only inviting more people into the market, it is also making the non-owner's position more fragile by continuing to solve political problems with borrowed and monetary means. That is why I say the Trump IRA is not only a retirement product, it is an inflationary asset excess mechanism. It pulls in excluded workers while reinforcing the old regime in which asset owners rise faster than wage earners. That is what the public needs to understand. Now let us move to the supply and demand side, because this is where the investment implication becomes obvious. The stock market, like every other asset market, responds to flows. Not perfectly, not mechanically, but flows matter. More people buying through regular automated contributions matters. Government matching contributions matter. New rails matter. Reduced friction matters. Lower minimums matter, even if the first year totals sound modest relative to the size of the whole market. The principle is still powerful. A new stream of steady policy, encouraged flows entering the market, changes marginal demand over time. And marginal demand is where price gets set. This is the sixth mechanism. I call it policy flow. Some of the strongest bull market structures in modern America have not come from retail genius or institutional brilliance. They have come from systematized flows, payroll deductions, retirement defaulting, target date fund automation, passive index accumulation, automatic reinvestment, month after month, year after year. Money arrives and buys, not because the owner woke up bullish that morning, because the system was designed to move money into assets whether sentiment felt good or not. That is an extraordinary force. It makes the market more resilient on the way down and more inflated on the way up. The Trump IRA, if rolled out the way the source describes, adds another policy-driven stream to that same universe. That is why the author is right to say it can create investment opportunities. Not because the stock market becomes risk-free, not because recessions disappear, not because crashes end, but because more money gets structurally routed toward the same asset pool that matters. Now here's where people become childish. Again, they hear that more money could be going into the market and immediately jump to the simplistic conclusion that stocks can only rise. Number, that is not how adult investing works. More inflow does not erase bad businesses. It does not erase valuation excess. It does not erase recession risk. It does not erase panic. In fact, it may intensify volatility because policy-supported inflows often create stronger booms and more emotional busts once expectations get ahead of reality. The source text is right on this too. Free money makes markets more volatile, not less. That is because policy money creates the illusion of a backstop without actually removing the business cycle. This is the seventh mechanism. I call it subsidy volatility. When the government supports participation, it raises the floor under demand over time, but it also encourages more people to think assets are something the state wants protected, that belief can inflate risk. It can also produce sharper emotional breaks when markets inevitably remind the public that no account wrapper, no subsidy, and no political slogan eliminates the possibility of losing money in the short run. That is why I do not treat a policy like this as an excuse to become stupid. I treat it as a reason to own the right kind of exposure. The source document points viewers toward total market exposure and broad SP exposure through examples like VTI and SPY. Good, that is sensible. If the policy is structurally designed to increase market participation and route more dollars into American financial assets, broad index exposure is the cleanest way to ride the tide without pretending you can predict exactly which stock will benefit most. That is how I would think too, not by worshiping the account, by respecting the flow. This is the eighth mechanism. I call it ownership positioning. If the state is widening the ownership machine, then I want to be positioned where the widened machine most directly sends capital. That does not mean blind optimism. It means understanding the hierarchy. First comes the rail, then comes the flow, then comes the support under prices over time, then comes the volatility that creates future buying opportunities for the people disciplined enough to use them. That is the real playbook. The source material also says something else I think is very important though. It only gestures at it. When the government pushes more people into the stock market while simultaneously running a debt, heavy inflation-prone system, it quietly teaches the public a hard lesson about the modern economy. The lesson is this: if you remain only a worker and a saver, you will likely fall behind to keep up. You must become an owner. That is the truth most politicians still avoid saying directly because it sounds cruel, but it is true. Wages are taxed, savings are inflated away, cash decays, assets rise. That is the machine. This policy does not cure that machine. It inducts more people into it that can be good for them. It also confirms how the system now really works. And that is why I think the emotionally important part of this whole debate is not Trump, not the branding, not whether it really ends up called a Trump IRA, and not whether the exact contribution thresholds survive intact. The emotionally important part is that the American government is openly acknowledging something profound. The 401k model, as it currently exists, leaves too many workers outside the asset escalator. And in a world where the asset escalator is how wealth really gets built, leaving tens of millions outside, it becomes politically and economically dangerous. That is what this policy is responding to. Not only retirement anxiety, systemic asset exclusion. Now let me say something that may sound harsh. The government is not doing this because it suddenly discovered a moral allergy to inequality. The government is doing this because a system where more and more wealth accrues to asset owners while tens of millions remain trapped in wages and cash becomes unstable. One response is to redesign the underlying monetary and fiscal structure. That would be the honest answer. The other response is to keep the structure and widen access to the assets it enriches. This policy chooses the second path that is politically much easier. And once you see that, you see the true philosophy of the Trump IRA: do not reform the machine. Expand the number of people attached to it. That is a very American answer and maybe the only politically available one. So here's where I come down. The Trump IRA could be genuinely useful for millions of workers shut out of the old employer. Linked retirement world, lower fees matter, portability matters, low minimums matter, a government match for lower income workers matters. Those are not fake benefits, but the deeper truth is bigger. This is not only retirement reform, it is monetary routing, it is asset market support, it is inflationary policy dressed as financial inclusion. It is the government admitting that in this system, ownership matters more than ever, and that leaving too many workers outside the ownership rails is no longer acceptable. That is the real story. So if you want to think like an investor instead of a spectator, do not get stuck at the level of the account wrapper. Look through it. Ask where the money comes from. Ask where the money goes. Ask how more debt and more asset access can both enrich investors and punish savers at the same time. Ask how regular flows into the stock market change the long-term structure even if crashes remain inevitable. Those are the right questions, because the people who do best in systems like this are not the ones who memorize the policy name. They are the ones who recognize what the policy reveals. And what this policy reveals is simple. The government may not be able to save the dollar, honestly. It may not be able to stop inflation, honestly. It may not be able to close the wealth gap, honestly, but it can keep doing what modern America does best: push more people and more printed or borrowed money into the one arena where ownership still outruns wages. That arena is the stock market. And if you understand that, then you understand why this is not a side story about retirement accounts. It is another chapter in the much bigger story of how America keeps turning monetary weakness into asset strength for the people positioned to own the ride.